Hi, my name is Mike Mills, and I'm joined by my partner Sarah Kyle here from the Legacy team. And we're here today to give you just a quarter update, second quarter update of 2024 on the markets. I hope everyone is enjoying the summer. I hope you're staying cool. We've had no problem staying dry, but hopefully everyone is staying cool. So with that, let's get into it.
Yeah. So, Mike, we've seen continued positive returns in the market so far this year, really. Can you give us a summary of what's going on, what we're seeing, what we can expect?
Yeah, great question. It's actually a lot of the same of what we saw in the first quarter when we did this video as well. I would tell you though, let me first kind of start by saying this. I think it's important to remember that we are long-term investors. Our goal is to invest for our clients and their families' lifetimes. That's long-term. That's not 1 year, 6 months, a couple of years. That's long-term as well. And this means we take the emotion out of investing for our clients. While volatility can cause a lot of emotions, it can get in the way of really wise investment decisions. We try to look beyond volatility to the long terms, and which often means staying invested rather than trying to time the market. Because we get that question a lot about timing the market, and it really doesn't pay off to try to time the market. It really pays off to stay invested in the market. Regarding capital markets and modern monetary policy, we believe the Fed's on hold for now. I think that's been pretty well televised, pretty well announced as well by the Fed. Big shocker to the market because, as we all recall, the market came into this year pricing in 3 to 6 rate cuts, and we get to have a rate cut. Our gut tells us that we may have a rate cut in the third quarter, maybe the September timeframe. And with that said, that could be the only one of this year. That could be our first and only of the year. And due to this, we like staying short on the curve for fixed income. Short to intermediate, I would say. Right now, short term, think cash, things like cash that are yielding in that 5 to 6.5% range. If we go a little slightly beyond that into intermediate, we can pick up 7, 7.5, even all the way up to 8.5 by taking just a tad bit more risk. So that's it really for the fixed income side and what rates mean for the market. I'll talk a little bit more about rates and their impact on some of the kind of the consumer and areas like that later. So we're starting to see the economy downshift to a little bit of a lower growth. Now that doesn't mean it's recession or anything like that on the kind of horizon. It does mean a couple other things. One, in addition to the economy starting to downshift a little bit and lower GDP numbers, is we're starting to see the consumer spend a little bit less. We all know the bite that inflation has had on people's budgets and their families' budgets. So we're starting to see that consumer shift down a little bit also. What that does mean, though, is it makes the economy a little bit more vulnerable to exterior shocks. Things that we'll talk about a little bit later. Things that we've all seen in the news as well this year, like geopolitics and elections and areas like that. One thing we do know for sure, and we all know this throughout the history of our country, which is 248 years old now, is that the American public's resilient. People will adapt. We used to say in the Marine Corps, we adapt and overcome. People are adapting to higher rates. They're adapting to higher inflation. It is our thought that we're probably going to be in this world of higher rates and higher inflation for some time, not months, but some time, maybe a year or more as well, before we start to see that kind of get tightened up. Yeah.
Yeah, so these higher rates are really good for buyers of debt, but talk to us a little bit about ways that that's negative for other sides of the consumer markets, particularly in home sales. I know that's been televised a lot.
Yeah, great question. Some of you that have met with us recently have heard us use the term the golden handcuffs. If you've read the news at all, you've heard golden handcuffs. Really, what that means is it's referring to homeowners that are in that 2 to 3.5% range on their mortgages. They're locked into these very low mortgages and have no desire to go take out a mortgage that's 2 and sometimes 2.5 times greater than that in this market environment as well. Also, it's really interesting. There was a report that just came out that showed that the median existing home sales price currently stands at $419,000. If you go back to 2020, February 2020, that was $270,000. That's a massive increase in the average price of a home right now. So you've got higher rates, you've got higher home prices, you've also got the cost of owning a home like insurance that's really pricing people out of that market. And really it's becoming a deterrent for first-time home buyers.
For sure. Let's pivot a little bit, Mike, and talk about AI and some tech stocks. Those we're seeing are continuing to lead the market, and especially the returns of the S&P 500.
Yeah.
What are you seeing with the rest of the stocks, though? Is everything else doing well too?
Yeah, good question. Let's touch on AI for a minute. A lot of people have heard us talk about this and have seen it in the news for well over a year now, particularly names like NVIDIA and areas like that. NVIDIA makes the chips that go into a lot of AI as well. There was a really interesting report, and it's very important for people to hear this because people think the market, and sometimes people confuse that with the Dow, which are 30 stocks. We refer to the market as the S&P 500, which is 500 stocks. but it's very important to know what that means. So if you look at the S&P 500 right now, year to date, so July of 2024, the S&P is up over 15% for the year. That's in an S&P cap weighted, meaning that higher cap weight to the larger companies that have the larger growth. I'll explain that in a minute. If you look at an equal weighted version of the S&P 500, which means all 500 companies are assigned the exact same weight, it's up like 5% for the year. Big difference there. Why is that? 60% of the return of the S&P 500 is coming from 5 companies this year. 5 companies: Apple, Meta, Nvidia, Amazon, Microsoft. Um, 5 companies. If you expand that out to 10 companies, you got 71% of the return of the S&P 500 for the year. Very important to know that it's not the whole S&P 500 that's doing well. Most companies in the S&P 500 are still undervalued, and we still see value there as well. Now, it doesn't mean we're shying away from the S&P 500. It just means the S&P 500 is not as diversified as people would like to think. Now, do we own it? Absolutely, we own it because we want exposure to those companies, but we also want diversity. So we have a diversified portfolio outside the S&P 500 as well. We like dividend paying stocks. Those aren't any of those 5 names that I just listed to you. Despite Microsoft and Apple paying a dividend and Meta now announcing a dividend, those are not your high dividend earners, your older dividend aristocrats as well. So what do we think for this market? And I think that's a question you didn't ask, but a question a lot of people are asking us as well is, we think the stock market's due for a breather. It took a little bit of a breather, particularly the tech names here in the last month and a half. We think in the next few months, you could definitely see a breather taken in the market. We don't see that as a reason to bail. We see that actually as a reason to add money. So if we see a breather and a little bit of a pullback, then we could start deploying more cash into that market as well. We don't believe it's a sign of a recession if you see a breather. It's just common, quite frankly. It's natural for the market to take a breather. So we've seen this market since really first quarter of 2023 go straight up, driven by what was the Magnificent Seven. Now it's really 5 companies as well. International markets, I'll touch on that just for a second. They're not nearly as fully valued as the U.S. markets. They're also not driven by tech and communication services. Those are the 2 highest sectors right now in the S&P 500. They're not driven by that. They're actually driven by a lot of dividend-paying, good quality blue chip style companies, and they're actually undervalued to a degree. So we see those as an opportunity to continue to add to our portfolios. Surprisingly enough, talk about international for a moment. If you look at the average portfolio, not ours, but the average portfolio out there, clients are underweight international, 2%, 3%, 0%. We're in the 5 to 15% range in international, depending on the model that our clients are invested in as well. And we believe in international as well.
So, Mike, you touched on how we do have exposure to the broad S&P 500. What about exposure to AI and those tech stocks that we're getting outside of S&P 500? How are we positioned in our portfolios to take advantage of future growth opportunities there?
Yeah, we're getting exposure to AI by way of the S&P 500 because it owns Nvidia, Meta, Amazon, Apple, Microsoft, and a whole slew of other companies as well that are involved in AI. I think that's important to know. We're getting that by way of specific actively managed ETFs like JGRO that we have in some of our more aggressive portfolios as well, that is specifically focused on the growth and growth tech as well. Also, I would say, and a lot of people forget this, that AI is more than just semiconductors and companies that are doing AI. It's the companies that are behind that. It's the infrastructure behind that as well. So in some of our private real estate, we own private real estate that owns data centers. Data centers are very important for NVIDIA and for AI and for everything that's tech related as well. And that'll continue to grow as well. So I mentioned earlier about pullbacks. If we see a pullback, we'll add to those areas because we think they are the driving engines of the market long term. It doesn't mean we bypass everything else out there. It means that that's a pocket that we do want to have exposure to. A lot of our clients will know that we've been neutral weight when it comes to growth in our portfolios. And particularly for the reason of we think that there's pockets of volatility there. Volatility is good though. Please don't confuse that with bad. Volatility is good for long-term investors. You want volatility because especially if you're averaging in like we do with most of our portfolios or rebalance, we want that volatility to be able to buy at a lower point as well. Not timing, by the way, just averaging in on the long-term investing. Let me touch on volatility though for a minute because there's some things that are external to the market that we believe will create volatility. As I kind of mentioned, I'll reemphasize volatility is good for long-term investors. And by the way, all of our clients, regardless of your time frame, are long-term investors because we're investing for your families as well. There's been volatility entering the market over the last few months. There will continue to be volatility in the next few months leading up to the election. Why did I say that? There's a number of major elections around the world right now taking place. Some you've already seen the results of. That's creating volatility in the market. Even just the idea of who's running for presidency here in this country is creating volatility in the market. That's not abnormal. That happens every election cycle. We have volatility leading up to the election. And then once the election results come out, the market knows who's going to take over the presidency and who's going to take over Congress and the House and all that good stuff. And then it settles down because now it knows what to expect for the next 2 or 4 years as well. So we don't see volatility as a problem at all. We just expect it, and we see it as an opportunity to invest for our long-term clients.
Perfect. Mike, do you have any final thoughts? Anything else you'd like to conclude with?
Yeah, let me touch on a few things. I mentioned our models earlier, so I'll kind of speak to our models. We're managing our models in conjunction with a number of firms that we really respect and we do meetings with on a regular basis. Firms like BNY Mellon, Goldman Sachs, JP Morgan, even First Trust. We'll sit down with them on a quarterly basis, if not more frequently, and talk global macroeconomics, and then do more of a bottom-up due diligence on the investments that we select for the model. So our models are managed not just by us. You know, the Wall Street Journal used to have a little monkey contest where we throw a dart and see what stocks. We do not do that. We put a lot of time and effort and due diligence into our investments, but a lot of time and research into our models with speaking to professionals like BNY and Goldman and JP Morgan and First Trust as well. Some final thoughts, just a couple things. One, as a reminder, we expect volatility in the coming months. It's typically the case in a presidential election. Afterwards, the markets will calm down. So it's no surprise to us whatsoever. We see volatility as an opportunity, not as a run and hide, if you will. As a final word, while we're enjoying talking about investments, and some of us enjoy more than others talking about them, I love investments. Planning and having a plan in place is much more important than just investing. We get that question a lot from clients, from prospects as well, as tell me about your investments. Well, my question is always, well, what plan do you have in place? Because if we think about that, after all, a plan will show you where to drive and what investments to use to get where you want to go, what your family's goals are. The investments are a byproduct of that. So we have to have the plan first, then we back into the investments and what model and what plan all works together for you as well. So I just wanted to kind of end on that note. On that note, though, I'll say that we hope you have a great rest of your summer. Stay cool. It's been hot. We're praying for rain here. Hopefully we'll get some rain. Look out for some exciting news from our team in the coming months. We've got some really exciting things happening, so just want to let you know that. Look out for that in the next few months as well. If you have any questions at all, please reach out to any of us here at the Legacy team. And as always, thank you for your trust.